What if I told you that inflation, the rising cost of goods and services, could actually be your golden ticket to wealth? In today's video, we're diving deep into practical steps you can take to not just survive, but thrive during inflation. Stick around until the end to learn real-life examples and case studies that bring these concepts to life. Step 1. Invest in inflation-resistant assets. Let's kick things off with a game changer. Inflation-resistant assets, such as real estate, commodities, and certain stocks, tend to retain or even increase their value during inflationary periods. Take real estate, for instance. Property values often increase with inflation, and if you own rental properties, you can adjust rent prices to keep pace with inflation. A real-life example is the case of John, a landlord from Texas. During the 2008 financial crisis, he invested in multiple rental properties. By 2021, despite rising inflation, his rental income had doubled, providing a stable and growing income stream. Step 2. Reduce and manage debt. Next, let's talk about debt. High-interest debt can become a major burden during inflation as interest rates rise. Prioritize paying off high-interest debt first. Consider refinancing your mortgage to a fixed-rate loan if you haven't already. Here's a story about Sarah, a young professional who managed to pay off her high-interest student loans by cutting unnecessary expenses and increasing her income through a side hustle. She then refinanced her mortgage, locking in a lower interest rate. This move saved her thousands of dollars, which she then invested in inflation-resistant assets. Step 3. Diversify your income streams. Relying on a single source of income is risky, especially during inflation. Diversify your income streams to protect yourself and enhance your financial stability. This could mean starting a side business, investing in dividend-paying stocks, or even creating passive income through online ventures. Consider the case of David, a software engineer who started a YouTube channel on coding tutorials. As his channel grew, he started earning significant ad revenue and launched a paid course. During the COVID-19 pandemic, when many were struggling financially, David's diversified income streams kept him secure and even thriving. Step 4. Invest in the stock market. Investing in the stock market, particularly in companies that can pass on price increases to consumers, can be a great hedge against inflation. Companies in sectors like consumer staples, technology, and healthcare often have the pricing power to maintain their margins. For example, during the inflationary period of the 1970s, many investors found refuge in consumer staple stocks. These companies, producing essential goods, continued to perform well despite economic turmoil. Additionally, investing in technology companies that innovate and improve efficiency can also be a smart move. These companies often have lower production costs and higher profit margins, making them less vulnerable to inflation. Furthermore, consider investing in exchange-traded funds, ETFs, that focus on sectors likely to perform well during inflation. ETFs offer diversification and lower risk compared to individual stocks. For instance, an ETF focused on consumer staples or energy can provide exposure to multiple companies in these resilient sectors, spreading risk and potentially enhancing returns. Before we continue with the next steps, take a moment to hit the subscribe button, like this video, and share it with friends who could benefit from these insights. Your support helps us bring you more valuable content. Step 5. Build an emergency fund. An emergency fund is your financial safety net. During times of inflation, having liquid cash reserves can protect you from unexpected expenses or income loss. Aim to save at least 3 to 6 months' worth of living expenses. Mark, a small business owner, learned the importance of an emergency fund the hard way during the 2008 recession. After struggling through that period, he made it a priority to build a substantial emergency fund. When the COVID-19 pandemic hit, Mark's business faced challenges, but his emergency fund allowed him to weather the storm without incurring debt. Moreover, having an emergency fund gives you peace of mind and the flexibility to take advantage of investment opportunities without the fear of financial insecurity. Step 6. Invest in yourself. Enhancing your skills and knowledge can significantly increase your earning potential. Whether it's through formal education, online courses, or learning new trades, investing in yourself pays the best dividends. Take Emma, who worked in retail but saw an opportunity in digital marketing. She took online courses and earned certifications. Today, Emma works as a successful digital marketer, earning far more than she did in retail and better equipped to handle inflationary pressures. By continually upgrading her skills, Emma ensures she remains competitive in the job market, regardless of economic conditions. In addition to professional skills, consider developing financial literacy. Understanding personal finance, investment strategies, and economic trends can empower you to make informed decisions. For example, after attending financial workshops and reading investment books, Alex was able to double his savings through strategic investments and smart budgeting. Step 7. Keep an eye on government policies. Government policies can greatly impact inflation and your financial strategy. Stay informed about fiscal and monetary policies, tax changes, and other economic measures. This knowledge can help you make better investment and financial decisions. During the post-2008 financial crisis period, many savvy investors kept a close watch on government stimulus measures and adjusted their portfolios accordingly, investing in sectors that benefited from increased government spending. For instance, infrastructure stocks often benefit from government investments in public works. By staying informed, you can position your investments to capitalize on policy changes. Additionally, understanding tax implications and taking advantage of tax-advantaged accounts like IRAs and 401(k)s can optimize your investment returns. For example, by contributing to a Roth IRA, you can enjoy tax-free withdrawals in retirement, which can be particularly beneficial during periods of high inflation. Step 8. Use inflation to your advantage in business. If you run a business, consider how you can use inflation to your advantage. This might include adjusting your pricing strategy, locking in long-term contracts with suppliers at current prices, or finding ways to increase operational efficiency. Laura, a cafe owner, started sourcing her supplies in bulk and locked in prices before they could rise due to inflation. She also adjusted her menu prices gradually to reflect the increased costs. These strategic moves helped her maintain profitability during inflationary periods. Additionally, Laura invested in energy-efficient equipment, reducing her operational costs and offsetting some of the inflationary pressures. Another strategy is to diversify your product or service offerings to cater to changing consumer needs. For example, during inflation, consumers might prioritize essential goods over luxury items. By adjusting your business model to meet these demands, you can maintain sales and profitability. Step 9. Consider inflation-protected securities. Investing in inflation-protected securities, like Treasury inflation-protected securities, TIPS, can be a safe way to protect your investments from inflation. These bonds are designed to increase in value with inflation, ensuring your investment keeps pace with rising prices. During periods of high inflation, many investors turn to TIPS to safeguard their portfolios. For instance, in the early 2000s, TIPS became increasingly popular as a reliable hedge against inflation. Step 10. Stay adaptable and informed. Finally, stay adaptable and keep informed about economic trends. The financial landscape can change rapidly, and staying educated allows you to pivot and adjust your strategies effectively. An example of adaptability is James, an entrepreneur who successfully navigated the dot-com bubble burst by shifting his business model to meet new market demands. His ability to adapt not only saved his business, but also positioned him for future success. With that said, thanks for watching, and until next time, don't forget to subscribe, like, and share.